Hi there and welcome to another episode of Money Managers, a User's Guide. I'm Nathan Peters. I have to admit I've still not recovered from the unbelievable demonstration of power to the people that was the GameStop phenomenon. When free money is thrown around freely, you really do get some odd outcomes. A Salvador Dali-like carnival of the absurd. And maybe that's entertaining, but I'm here to tell you that's not investing. Now this new force in the market, call it Money Musk Mania, MP3, whatever. It's creating a windfall for Wall Street, as we discussed last week in our SPAC episode, and even for pros able to harness the ephemeral whims of Wall Street bets and their ilk. Take a look at this track record of a market-neutral quant equity fund run by BlackRock's Scientific Active Equity Group, which explicitly uses natural language processing algorithms to read retail sentiment. Post-COVID, they've had a 30% run-up on no market exposure, which is truly remarkable. So what does this portend for the future? You guessed it, Wall Street will make more. We heard this week that VanEck is going to resurrect a social media sentiment ETF based on the Buzz Next Gen AI US Sentiment Leaders Index. The last time this index was licensed to do an ETF, it failed for lack of interest, but Wall Street will never let a failed idea go to waste when there's money to be made. Now here's the website for Buzz. Portfolio turnover is about 15% per month, and they scrape a wide variety of investment-related venues on the internet and try to boost performance based on AI that tries to improve the forecast accuracy by upweighting particularly influential voices. I have no idea how robust their methodologies are, but I do know that we can run portfolios through Venn to see what we're really working with here. And given we've just had the biggest market event of our lifetimes occur, I thought it'd be interesting to compare a pre-COVID portfolio from a year ago with the current portfolio. Just really find out what's changed in our pump and dump habits and what hasn't, shall we? Cool. Okay, first, a brief housekeeping point. Given the surge in IPOs and SPACs recently, I've omitted those names from the current portfolio since they offer limited data and have essentially just added to returns. For those keeping track, the omitted names are Cloudflare, Peloton, Nikola, DraftKings, and Virgin Galactic. Otherwise, all the names are known entities with at least a couple years track record as a listed company. Okay, so what do we know? Well, we know that social media loves outperformance. Today's portfolio is up 145% in the last year, while last year's portfolio is up 65%. Tesla is the biggest winner that we loved pre-COVID, while Novavax, Moderna, and Plug Power were the biggest we wish we knew then what we know now winners currently. But what about the equity factors that we just can't get enough of now as a collective? Well, compared to last year, we want more equity risk. We want more volatile stocks. We want less credit shorts. We want more expensive stocks. And we want more leverage stocks. Now, does that sound ESG and sustainable to you? I guess it works until it doesn't, right? Well, that's it for our episode this week. Thanks for making it this far with me on Money Managers, a User's Guide. If you find this content enjoyable, please like, share, comment, subscribe, and hit the bell for notifications of future episodes. Remember, use your money manager. Don't let them use you. Thanks.